if you're a long-term buy and hold investor like Warren Buffett, then just become his best friend and do whatever he does, right? And here's why he's successful. Not because he's the most savvy investor in the world. Why is Warren Buffett successful? He's got enough cash that when he buys, he forces his own people on the board of directors. And then they control the company. That's why he's successful. Not because he buys the best stocks undervalued, because he buys enough of them that he appoints or has enough power to help appoint the board of directors who then make the changes necessary for that stock. That's why he's successful. Now, how many of you have enough cash to buy enough shares of stock where you control the board of directors? And if you don't, become Warren Buffett's best friend. Otherwise, you can't use just fundamentals alone to buy and sell. Because even though something's really good, got excellent fundamentals, if investors aren't buying it, they're not buying it. Why aren't they buying it? I have no idea. Institutional investors will buy whatever they feel is best for whatever reason, not because of fundamentals or because of price, because of whatever they personally feel when they're buying. They get up that morning and they have a fight with somebody. They're in a bad mood. They'll start looking for stocks that focus on knives and whatever else. I don't know. I'm making stuff up. You understand where I'm coming from, correct? Yes. Investors who control what's bought or sold buy and sell based on what they think is best, not strictly the fundamentals, not strictly the technical analysis, not strictly the news, based on whatever their thought process is geared toward. You will buy and sell whatever strategies fit your own style, not based on what somebody tells you is the best, based on what your style is. So use fundamentals and technicals and news all together, but you still buy and sell what you want. So simple concepts, those are what I'm after for my technical analysis. All right, choosing the strike price. Don't have enough. Let's go to covered calls. Great strategy if done correctly. Can be used for both stocks. Can be used to protect following stocks. Strategy must be monitored. I like covered calls. Most people get excited when they first learn them, specifically because, do you mean that if I own stock in my 401k, the entire time I've owned it, I could be selling calls against it and make some cash? Most people never heard the concept. So when they think about how much money they're missing every single month, they get excited about that. So my dad, when I first learned about the stock market, owned Boeing stock. So when he first learned about Boeing stock, he said, man, I own this many shares of Boeing stock. I've been buying it in my 401k, and Boeing's been matching buying stock in my Boeing stock. I got this many shares. If I would just simply write covered calls every month, when I take controls, I can make X amount of dollars on top of my pension. Yes. And people get really excited when they hear that. Now, the downside of this is that most people never really learn how to trade covered calls. Because all we learn is, well, stock's at $44, and if I sell the $45 call, I get paid this much money, and if it goes up, I get another dollar? Yes. And then we start thinking, that sounds great. However, what if it goes above that price, and I get called out? Possibility? Yeah. Here's how I want you to start thinking like an investor. You got the education part done. Education's done. Let's think like an investor and use the information to make some cash now. How real investors do this. All right, stock's at $44 per share. And I want to sell the $45 call on a stock that I own. Now, most people don't actually want to ever sell the stock. They just want the cash. That's what talking, emotion or logic? Emotion. Emotion good when you're trading? Logic says, who cares if you sell it? You made your profit, go buy another good quality stock. Or wait for that stock to pull back on the next cycle where it's in the up and down cycle. Wait for it to pull back and buy it again. That'll still work too, yes? Yeah. Okay, but most people don't think that way. So let's just use the emotion side and see what we can do with the emotion side. Logic says, I don't care if I sell it. Buy another stock. Because the stock you were in, it goes up and down and up and down, up and down anyway. So take your cash, move another stock, keep on trading. So I buy a stock. I'm in my stock. It's at 44. I sell the September $45 calls. I get $1. $1 cash. You got 1,000 shares, you made $1,000. It's in your account. 500 shares, you made $500. Either way, whatever you have, $1 for every 100 shares that you have for each covered call. Yes? Okay. So you got your $1. Now it's going to do one of three things. What's it going to do? Go up, down, or sideways. Go up, down, or sideways. Could you pull? Let's go back to our CSX stock board. CSX. And I'll look at any stocks you'll look at as well. We're done with this. Okay, so we're in our stock on CSX, and it looks good. It's in an uptrend. It just hit 45. Started to pull back a little bit. We think it's ready for a little pullback. My MACDs are starting to drop right now. By the way, when is the best time to sell an option on a stock that you own? Like, let's say you own the stock, CSX. You think they're doing a covered call trade?
A couple weeks before the expiry date.
A couple weeks before the expiration date. Good. Are you Canadian, eh?
Okay.
Are you Canadian? Okay, good. Anybody know how you know? Expiry date. Expiry is a Canadian term. The expiration date, expiry date, exact same thing, just two kind of exact same thing. So it's just called expiry in Canada. All right. Which by the way was completely foreign to me. The first time I came out to, I wasn't very bright in school. First time I came out here to Detroit, I was driving and said, Canada, next exit. I said, well, what's Canada in the middle of the United States? You don't think that unless you're from this area. I was from Seattle, so for me, Canada is north. Victoria is north. South, you come all the way down here. What's Canada doing way down here? You
Canada, south.
Yeah, well, you don't think of that.
Yeah.
South. So you look at your stock. The best time to sell the cover call, the option for a cover call, is when it's worth the most amount of money. Simple, correct?
Simple.
Okay. When is it worth the most amount of money?
When it's the highest.
When it's at its highest point, which means right before it drops. So if you're going to sell a cover call on a stock you own, when would you consider selling it? Right when your oscillators, like your MACDs and stochastics, are high and your stock is at resistance. Wouldn't that be the time to sell it? Because that's when it's at its highest, which means that's when it's worth the most amount of money. So, which is pretty much what? Where CSX is right now. So you own CSX, it's in your account, and you've got at least 100 shares, so you sell the September 45 calls. Now, based on what you're after, the drawback is it could go above 45. So let's say you own it right now, you sell September $45 calls, and the stock stays below $45. You get your dollar cash because you sold the September 45 calls, you sold the call option, cash goes in your account, $1 per share. And so it just lowers your basis a little bit. Now, stock could do one of three things, yes? Before you enter the trade, you will understand the trade and what to do if it goes up, down, or sideways, how to alter the trade. All right, so if it goes up, now if it goes up above 45, will someone buy the stock for you? The stock goes above 45. Someone paid you, I pay you $1 per share cash for the right to buy your stock at 45 between now and the close of day, Friday, third Friday of September. It goes above 45. Will I want to buy it?
Sure.
In fact, if it's at least a nickel above 45, is it an automatic exercise? It's automatic. If it goes at 45.05, it's automatic. It'll be pretty out of your account. All right. So if I don't want to sell it, if I don't really want to sell it, if this stock goes to 45.50, one day, boom, 45.50. So Monday, this Friday, Monday, it opens flat, and by the end of the day, it's at 45.50. Is that a possibility?
Sure.
So just go through the ceiling. 45. My question would be, did it happen on a volume spike or not? It didn't happen on a volume spike. I'm hanging on to it. I'm not doing anything whatsoever. Someone says, well, yeah, but Michael, what if they exercise the stock on you and they buy the stock at 45? Well, you're going to lose it. I'm just going to turn around. It didn't go above 45 on a volume spike, which means it wasn't a lot of buying. It was just market fluctuations. And my MACD and stochastics are still overbought. Let them buy it. It means there's probably a good chance it's going to do what? Let it pull back now. You just sold it at 45. Let it pull back to 44 and buy some more at 44. Wow, now you bought even more at a lower price. So you got your original $1 to begin with, and you bought it for 50 cents lower than it was when you sold the covered call. You've made $1.50 so far. So I'm okay if that happens. I don't really care if I own it or not, but I don't really want to sell it. So in money sense, if I let it go up, it's just fluctuating. So if they buy it early, I'll buy it early. By the way, how often do most stocks get called out of your account early if they're right around the strike price?
Not very.
Very rarely. The only time stock ever gets called out, not the only time, the majority of times the stock gets called out of your account early, if you sell a covered call on it, is if it makes a massive $45. And even then, it usually only happens right before it starts to drop, because that's when it's in the market maker's best interest to exercise that option against you. If it's still going up, remember the market maker paid you $1 for it to buy stock at 45. All they have invested is $1.